Our guest this week is Sonia Nagar, co-founder of SNAK Venture Partners. SNAK's a Chicago-based firm that invests in seed-stage marketplaces. We talked about why SNAK loves marketplaces, what surprised Sonia about starting a new firm, why SNAK prefers B2B to B2C, and how AI has and hasn't changed marketplaces. It was a really fun episode. I hope you enjoy. If you're new to the show, please have a listen, subscribe, and you'll listen to more. If you already subscribed to the show, we appreciate all the support. We've got a lot more listenership. It's going strong. Really grateful for that. So thanks. Please enjoy. Sonia, thanks for coming on the show.
Thanks for having me.
So maybe to get rolling, SNAK is fairly new. Do you want to talk about SNAK and what it is you're doing?
Sure. So SNAK is a seed stage fund focused on helping founders build category defining digital marketplaces. My partner Adam and I spent me 9 years, him 19 years at a larger fund called Pritzker Group Venture Capital, where we had pretty good run investing in digital marketplaces, both B2B and B2C. And then spun out about 6 months ago and launched a fund that is wholly focused on the thesis of investing against digital marketplaces that have an opportunity to be category defining and are a first mover.
All right. What surprised you? I want to come back to a lot of that, particularly around B2B and B2C on the marketplace side and what interests you there. Mm-hmm. But what surprised you most about going out and starting your own shop?
Well, so job one when you decide to launch your own firm is you have to fundraise to get the funds to be able to invest in other startups. And so we had a big leg up in that Pritzker Group anchored our fund, which gave us a ton of credibility at the door. And we were able to hit our fund target in our first close, which is pretty atypical. But it still surprised me at how hard it was. A lot of people or institutions that I thought were a sure thing, were much longer conversations or ultimately have not yet come in. I mean, I feel like that surprised me. The LP process surprised me.
Yeah. Being on the other side of the table.
On the other side fundraising. I think it's
getting all the no's.
I think it's important for having empathy with founders and that founders know, like, listen, we got to fundraise too. So we understand that it's hard. But the process I think there's been a spotlight shown on the founder fundraising process to say, like, there are best practices. There's a certain etiquette, business etiquette of following up or closing the loop or trying to be respectful of people's time. And I think the LP world, the limited partner world, is just more opaque. And so there is none of that. And so it's an interesting space for sure.
You were involved with some big wins at Pritzker, and you kind of alluded to that. Which of the ones that you worked on while there was the most fun?
I think I would say Backlot Cars, which is a deal that Adam and I did together, was a lot of fun because it was fairly fast from when we invested through when they exited. And I think I learned a lot. That was one of the first B2B marketplaces that I had invested in. Previously, I had done a lot more in consumer, both as an operator and a founder. And so it was interesting to get exposure to some of the unique dynamics there. And that's, part of we're leaning a lot more B2B than B2C these days at SNAK. And I think some of the information we have on what a great marketplace looks like comes from our experience with Backlot Cars.
Why more emphasis on B2B versus B2C?
So interestingly, from like 2010 to 2020, we had a ton of consumer wins in marketplaces, Airbnb, Uber. There's just a lot of very large TAM consumer categories that have already been covered. And so when we think about, especially for marketplaces, there are advantages to being a first mover and establishing network effects, which make it very difficult for somebody to come in behind you and follow you. There's not a lot of white space in consumer, whereas in B2B, industrials specifically, we just think there's a ton of white space. There's a ton of folks when you're talking to folks in certain categories like construction, energy, metals, most commodities, they're still transacting offline, but they've been trained by the last decade of consumer experiences to expect better and more efficient transaction processes. So it's like a great time to be investing in B2B. We still will look, we say there's like 3 pillars of where we're investing. One is helping bring old line industries online, so categories where you can be a first mover. The second is, and the second 2 themes touch consumer a little bit more. If you can find a high purchase frequency category of consumer that has not yet been brought online, like that would be interesting to us. And then we are interested in businesses that are helping people monetize their time, energy, and skills in new and interesting ways. So for the latter, we use Spot Hero as our example. The parking spot marketplace was an investment my partner Adam led at Pritzker Group. And then the former category, think Cameo, where people are getting paid to do celebrity shout outs. That was a new behavior, a new way for people to monetize their time and energy.
I did a cameo for my son where I got a sprinter. He ran at University of Georgia to do a video for my son during the COVID lockdowns as kind of a pick me up. And it was so great. Like my son was completely blown away. I
Yeah.
don't know how that's ultimately worked out business wise, but product wise, it's a great experience. It's really cool.
I think ultimately it has created a cultural phenomenon. Like it is, people know what Cameo is, and there's value that's been created in a way where like it would be hard to copy what Cameo has done. Like in that category, they own it. So I think there's a good business there. But yeah, as an investor, depending on when you invested, it hasn't played out the way people thought.
When you were talking about B2C there on the marketplace side, which do you think is more likely? Finding something that a founder has identified some vertical or TAM that hasn't already been covered, or there just being some entirely new vector to how like consumer marketplaces are done through AI. And part of the reason I ask is, I see much the same thing as you, where TAMs keep getting smaller and smaller on a lot of these things, and just curious, like which seems more likely to bear some fruit.
Yeah, I mean, I if I was to guess, I think we'll be 80, almost 90% B2B in this fund because there's just so much white space and opportunity. And we're seeing tremendous amount of deal flow there. And it's just harder to come up with a new category of consumer behavior or a new way for, that's one of those where it's like we'll know it when we see it versus in the B2B side, we actually are fairly thesis driven and can do some outbound because we know what categories we think are ripe for disruption. And so we can either create content to drive inbound deal flow or go talk to accelerators. And we have a very specific idea of what we're looking for, which is helpful when we're hunting for deals.
What do you like most about marketplaces, just as the business model?
Yeah, so that would be the network effect. So once you get to scale with a digital marketplace, there's like a flywheel that can kind of take off and inflect, and you see nonlinear growth when you've got buyers and sellers that are finding liquidity. And if you're a first mover, there's initially no other competition. It creates a flywheel for other buyers and sellers to want to join the platform, and you get a true competitive moat in a way that you don't have in vertical SaaS. In vertical SaaS, I feel like you're only as good if you're building HR payroll software. Like you're only good until the mobile first payroll software comes out or the AI enabled payroll software comes out. You've got to kind of constantly be fighting off copycats and competition versus in marketplaces, you just don't have that dynamic is a lot harder. It's a lot harder to displace an incumbent marketplace.
Last year, the amount of money that VCs put into SaaS at Series A was 17x what they put into marketplaces, despite 4 of the 5 most valuable tech IPOs of all time being network effect driven.
Well, I think, for a while here, there was a bunch of Uber for everything pitches in consumer where people were pitching the Uberization, the on-demand everything for consumer. And a lot of those startups failed. And so there has been, I think people realize very quickly that being a copycat, so being a second mover in marketplaces doesn't work. It's a great way to lose money. Maybe you can be a fast follower, and sometimes it's winner takes most. And so, you got Uber Lyft as a dynamic. And then I think the kind of next wave of B2B marketplaces is just started taking off. So for a long time, and there's a Bill Gurley article about how when you're evaluating a marketplace, one thing you should look for is whether you can be in the payments flow. So for consumer, often you have like lower AOV transactions that are happening immediately. And so you can use a payment processor. And those were kind of like the first wave of startups that came online. In B2B, you often have longer purchasing cycles. And so it was harder. This is like part of the why now in our thesis of like what's changed. Why can you do B2B marketplaces today? But 10 years ago, it would have been really hard. Before Plaid and Stripe and a lot of the embedded fintech solutions, it was harder for you to build a B2B marketplace because you would not only have to be an industry expert, because that relationship and network is more important in B2B, but you would also have to effectively build banking functions. And that, for an industry expert, if you were an industry expert in like recycled pallets, would be very difficult to do. But all that, like Stripe was founded in 2010, Plaid was founded in 2012. We've seen some wins in categories like auto, ACV auctions, and backlot cars being two examples, where you have these longer purchasing cycles, but you are now enabled by fintech solutions that were not as easy to access 10 years ago. So I think we're at the very beginning of the B2B wave of marketplaces. There are still some great examples. If you look at the most valuable private companies, like Fair is up there as a big winner, which is a B2B marketplace. I don't think in the winning companies, you're still going to see marketplaces there, but they have fallen out of favor. I think in part because of some people getting burned on staying too long in the consumer sector and investing in things that were not novel. But I think the B2B wave is just starting.
A pushback I get from talking to other investors sometimes who aren't into marketplaces as we are is they have a vibe that they're not very capital efficient and require a lot of capital. And I don't know if that's a hangover from, the vast amount of money that Uber raised over the years, but curious if you get that pushback and whether or not you think it's valid and how you think about capital efficiency with them.
Yeah. I mean, I think in consumer and for Uber, Airbnb, Instacart, many of them were not very capital efficient in the early days, and they relied on huge consumer scale in order to be, to survive. I don't see that in B2B marketplaces as much. Often B2B marketplaces are more efficient and they're being forced to be more efficient. I think a lot of the big consumer wins, Uber, Airbnb, et cetera, they had access to capital. And so they built models that use a lot of capital. If you're trying to build a consumer brand, that's very expensive. You don't have that same issue in B2B. I mean, I will say marketplaces can be more expensive because you have to build supply and demand at the same time. So you've got two customer acquisition costs. Sometimes there are certain markets where the supply and demand is the same. So for auto, for ACV auctions and backlot cars, they were helping dealers transact and buy and sell used vehicles off their lots. Their one big advantage they had was the buyers were the sellers and the sellers were the buyers. So they still had only one acquisition cost. And I think that's why you saw them inflect and be very successful and fairly capital efficient over time. So I think it more has to do with the ethos of the founder and their access to capital. Like if you give somebody $10 million versus $1 million to build their business, they're gonna use it. Today, because there's less funding, we're seeing a ton of very capital efficient marketplaces that are not kind of falling into that stereotype of being less efficient to build.
What advice would you have for marketplace founders who have early signs of product market fit but are having trouble getting investors engaged, interested?
Yeah.
Other than coming to you.
Yeah. No, I mean, I think I feel so much of, and I learned this lesson the hard way when I was a founder. You've got to qualify your leads and who you're spending time with the same way you do for your business. If an investor is not at all interested in marketplaces, then you're going to have a really hard time selling them. I do think that there are two ways that you can approach looking at marketplace businesses. You can either look at it as a model or you can look at it from like an industry sector perspective. And so I think, as a founder, maybe you're a healthcare marketplace or an industrials marketplace or an energy market. Like figure out who are the investors that either invest in your industry or have an interest in the marketplace model. And And then the best thing you can do is be super, capital efficient and thoughtful about how you're growing and using customers to fund your growth. And for B2B marketplaces, you do get access to AR lines and other forms of non-dilutive capital, or you can, if you need to help fund your growth in the near term.
If you were starting a new B2B marketplace today, would you tilt the scales of your time and energy more towards the supply or demand side to get started?
So it's interesting. I feel like, so for consumer marketplaces, they tend to be supply driven. Consumers are all out there, and if you've got the supply, and especially if you have unique supply, then that's a real advantage. I'm seeing both in the B2B market. So sometimes I'm seeing folks figure out their unique supply advantage, and then figure out how to get, if they're bringing a category online, sometimes they're able to actually get the vendors or the supply side to pay for online marketing to help to build demand, which I think has been a really interesting strategy. The flip side is, if you look at the procurement function for a lot of industries, that's effectively the demand side for many B2B industrial marketplaces. I've seen a number of founders figure out ways to make procurement more efficient. So they've started off by acquiring somebody who has a bill of materials to manufacture some product. And they've said, hey, give us your whole list of your bill of materials. We will, using AI and other things, automatically automate the process of getting multiple bids and quotes. And they've used the demand side to build their business. So I don't think there's a right or wrong answer. But I think at some point you need to have proprietary supply. Like, you need to have differentiated supply in order to be sustainable. But getting started, you could get yourself off the ground with either. I've seen either strategy work.
Obviously, you spend a lot of time thinking about network effects. How do you think about network effects and building your own firm?
We think a lot about the founders that we're building into the mix, and the fact that they should all be able to help each other, because they are all building marketplaces. And there are unique qualities to that are shareable, or lessons learned that can be shared across marketplaces. And so I think there's two things we're thinking about right now. One, the founder network is the most valuable thing. Like, they are helping each other. On the LP side, we love that we have some of our LPs have been successful marketplace founders we've invested in, so they can help. And then we also think about like talent networks that we can build that can be shared across our network. And so, we make a concerted effort to get to know the best folks in B2B sales, marketing, growth hacking, SEO, SEM, also on the operations and finance side, some best practices there. So we think a lot about like how the insights make the community more valuable.
How do you think about relationship building with downstream investors, so Series A and beyond?
Yeah, it helps that we were Series A investors previously. So we have a great network of folks. What we've found is, when marketplaces, a lot of people don't like to invest at the seed stage for marketplaces, which is why we focus there, because there's a lot of white space, less competition. Once you get a marketplace to scale, like past 10 million in GMV for the Series A and past 50 million or 30 to 50 million in GMV for the Series B, there's no shortage of later stage investors that love marketplaces. Bessemer, Insight, A16Z, Sequoia, they have all made significant money on marketplaces. And at that stage, you can rely on the data and look at there's a lot more that you can do to understand that this is a successful scaling business. So we think about it as like, we invest in great founders who are doing great things, and like we have no shortage of people we know at the later stages, but making sure that the companies are ready to go talk to them is a big part of that. And then from a brand perspective, we are trying to invest in doing content. Like, we just launched a newsletter where we talk about building marketplaces, things we're learning. So those are our two strategies right now. It's just relationship driven, and then trying to do a little bit more on the content brand building side.
What's something you've changed your mind about in the last few years?
The biggest thing that I have changed my mind about is, it feels like and I might be wrong on this, at the seed stage, the most important thing is your industry networks and relationships, and you can hire and build out the engineering team because it's gotten so cheap and easy with AI to build basic software to prove out that you have an MVP product that's working. I think 5 to 10 years ago, if you did not have an A CTO engineer, like a real A player CTO engineer on your team, I probably would not have spent as much time on the business. And I still think if you're building an AI or developer tools, or like there's still some categories where you've got to have your A plus founding team needs to have an A plus engineer. But I think for B2B marketplaces, and this may be controversial and may be wrong on this, we'll find out as the fund matures. I think you can get away with at the seed stage, like proving out the marketplace value proposition and getting your first, let's call it 5 million of GMV with like an MVP product. And then you can hire a great CTO with that traction.
You're based in Chicago.
Mm-hmm.
Is there a geographic tilt for you away from the coast? Or are you equal opportunity on wherever great deals are?
Yeah. So we are equal opportunity on wherever great deals are. However, our thesis right now, we have a thesis that we want to invest in businesses that are building startups that are bringing old line industries online. Supply chain, logistics, manufacturing, and then in commodities, energy, agriculture, livestock, and metals. And so by virtue of us being focused on these unsexy industries, just a lot of the talent is not in New York or on the coast. Like a lot of the folks that have the deep industry expertise and the networks and are the best founders are not on the coast. They're in middle America. And so we do end up with a geographic bent, but not intentionally.
I hear that. The last 2 deals I've done were both marketplaces out of Utah, one of which I co-invested on. It was great. What's a conventional view in venture you think is bullshit?
I mean, the craziness around AI, I kind of am calling bullshit on. I feel like in order to have a successful AI startup, you need compute and you need a lot of data. And an early stage, like seed stage startup is unlikely to have that. And so if you're pitching me on like a marketplace that magically is using AI on day one, I'm highly skeptical. And I know agents can be used to replace some of the service functions, but that to me feels like fringe benefit versus the actual like liquidity is the number one benefit in a marketplace. That you are connecting buyers and sellers that previously were not connecting as efficiently because there was either geographic restrictions in the way they were transacting or payments. They were using paper and email and fax, and you're making it more efficient by bringing it online. AI is not the primary value proposition there. It is an enhancement to the process and can be used in many ways, but it's not the thing that gets me excited. So the valuations that like people are getting for companies just because they're using a .ai domain or claiming to have it, I mean, a lot of it is machine learning and heuristics, and it's not even real AI at this point. When you dig in on a pitch, when they're like, oh, we're using AI to do contracts, and you're like, really? Did you need to use AI for that? Or could you just use machine? I mean, yeah.
Yeah.
No.
Also, I'll see a deck like that, and that's cool and all, but it's the 20th deck that I've seen about looking at contracts with AI. And
Right.
Yeah.
So.
This is a fun conversation. Is there anything out there or anything you'd like founders or listeners to know about SNAK that we haven't already talked about?
Yeah, we're out there doing deals, writing $1 to $2 million checks, trying to lead at the seed stage. And so if you're building a startup especially a B2B marketplace that's bringing a legacy old line industry online, we'd love to talk to you. And it's never too early to start getting to know us. So if you're in thesis, even if you're at the pre-seed stage, we would still love to talk and get to know you.
Awesome. All right. Well, Sonia, thanks again for coming on the show.
Thanks for having me.
Hi, Joe again. Thanks for watching the show. If you'd like more of this in the future, subscribe to our channel. If you'd like to learn more about Seaplane Ventures, just check out seaplaneventures.com. Cheers.